is try to put the slides that I'm going to be using up on the screen. I'll leave them there while I'm talking, and then once we get to the Q&A, I'll take them away. So in my day job, it's my job to try to make sense of the global economy and global capital markets, and to try to translate that into useful advice for our clients, which tend to be wealthy individuals, small institutions, and companies. As part of that job, there's a lot of interaction with the media debate, which is fascinating. And the longer I do this job for, the more I'm really engrossed by the way in which the media and capital markets intertwine, feed off each other, and come to believe often some rather unusual things. Outside the day job, at the moment, one of the things I'm doing is sitting in an advisory capacity on a panel which is advising the Cardiff Capital Region deal on how best to invest £500 million worth of public money in trying to make the South East Wales economy function, not just to make it grow, but to make it a little bit more equitable and sustainable at the same time, perhaps. So I do have some sort of skin in the game, as it were, in terms of trying to work out how best we might go about organising and thinking about economies. I should say immediately that what I'm about to say, my personal views only. Please don't hold any of my employers responsible for them. And I'm also aware, obviously, that we're talking at a very difficult time, and even to be talking about finance and economics at the moment seems to be a little bit of a luxury. So it should go without saying that my thoughts, of course, are with everybody affected by this horrible virus and all those who are supporting and looking after them and helping keep the show on the road. So we are talking here, though, about economics. Here's the title I've offered. And in terms of how I thought we'd break things down, I thought maybe I'd gather my thoughts under three broad headings. And this is intended very much, as Keith was saying, to be an exchange of ideas. I don't want this to degenerate into me throwing lots of PowerPoint pages at you and droning on. I'd be very interested in your thoughts when we finish this. So it is a conversation. And I'm going to talk around these three broad headings. I'll talk about where we are now. I'll talk about the nature of economics and what passes for economic knowledge. And I'm going to ask, how sure can we be, which for some of us, 1977 vintage, may be a phrase that chimes. I'll talk a little bit about that. And then I'll finish up by offering some thoughts on this way of economic organization, allegedly, that we call capitalism. So without further ado, let's go on to where we are at the moment. And what can we usefully say, because there's a lot of stuff being said at the moment, what can we usefully say about this particular economic downturn? Well, it really is very special. For once, the superlatives are justified, they're warranted. This is the most sudden and most precipitous decline that we've seen in the global economy in modern times. As recently, relatively recently as early February, the global economy seemed to be gathering momentum and picking up, having slowed down a little. We then promptly fell off the edge of a cliff very, very markedly in terms of economic activity. And in terms of the data we're seeing some really exceptional and unusual data suggesting that not only is this the fastest, most sudden downturn, but it's also likely to be the deepest on some comparisons since, well, for many, many years. Here's an estimate of the latest US unemployment rate. It almost certainly underestimates the number of people filing for unemployment insurance in the US. Taking the figures at face value, this is the highest rate that we've seen since the 1930s, which is prompting all sorts of comparisons that personally I think are a little bit premature and tactless, but we'll come back to that in a second. But understandable, you can see some very sensational figures out there. Economies falling at double-digit non-annualized rates of growth, probably in the second quarter of this year, for example. Another way in which this is special is it's the least disputed, the least contentious downturn that I can remember. Usually when economies go into recession, there's a big debate, a huge debate beforehand about the appropriateness of policy. Will there be a downturn? Won't there be one? A lot of debate, often a lot of blame. Is policy to fault? Is a particular sector to fault? This is the least disputed and possibly the least blameworthy of the downturns I can remember watching. There was no disagreement. The instant that it became clear that the lockdowns in the Western economies were going to be as severe as they were, from then on, there's been no dispute. This is a significant, very big downturn. And as I say, it's unusual for there to be such agreement. If you follow these things a little bit more carefully, you might be aware that this is the first time that the sectors which have led the way down have actually been in the service part of the economy, not in the manufacturing and traditionally cyclical part of the economy. In terms of the financial markets, it's the least of our concerns at the moment, or should be. But if you follow those, you'll be aware that we've seen record levels of implied volatility. We've seen the fastest ever bear market in US stocks. We've also seen the fastest ever bull market. And in terms of the policy response, that's been sensational as well. We've seen monetary policy and fiscal policy respond very, very quickly and in a big way, in a scale and with a rapidity that we haven't seen in the past. Now, it's tempting, thinking about that policy response, it's tempting to think, well, maybe if policy is acting so quickly and so promptly, maybe there needn't be a big downturn. Maybe policy will actually somehow rescue us at the last minute. I think that might be to be missing the point, because it would be a bit weird if, on the one hand, we were to be closing the economy to deal with the virus, but with the other hand, we were trying to keep it from being closed in order to keep economic activity up there. So the point I'm making is that for me, the most important way in which this is a pretty special downturn is that it's the first ever deliberate downturn. Collectively, we and our governments have decided to suppress the coronavirus by stopping meeting and traveling. And if you don't meet and travel, you can't do as much business. You can't go out to work as easily as you used to. And funnily enough, for me, this actually makes the situation a little bit less troubling. Well, it's still pretty troubling, but it makes it a little bit less sinister and daunting than otherwise could be the case. And all the other big downturns that I can remember, as I mentioned, none of them recently have come close to this. They were all associated with big macroeconomic imbalances and things which had to be corrected and which in some way meant that there needed to be a downturn. It might have been inflation, it might have been reckless borrowing and lending. We've seen that, goodness knows, often in the past. This time around, it's a deliberate downturn. And the reason that makes me feel a little bit more positive going forwards and hopeful that it can be reversed is that we knew how to close the economy down. We know how to start it again. Now, obviously, the lockdowns are going to be loosened more slowly than they were introduced, and some businesses sadly won't make it through to the other side. But essentially, that deliberate nature of this downturn for me suggests that one of the other ways in which it may yet turn out to be unusual is that it may yet turn out to be relatively short-lived. So the downturn was concentrated very much in about 6 weeks in the Western economies, about 6 weeks maybe from the middle of March onwards. We're still reading in the news about the data relating to that period. So funnily enough, the worst in terms of reported data is still ahead of us. When we get estimates for GDP in the second quarter of the year, that's likely to mark the low point in terms of quarterly numbers. In terms of monthly data, when we get more data for April, that's probably going to reveal itself as the lowest or the weakest individual month. So we're still waiting to read about exactly how deep the hole that we fell into was. But funnily enough, as we're speaking, as we're waiting to read about it, and as the newspapers and media are reporting it, we're probably improving now. So if we look at real-time statistics in terms of travel, energy usage, what people are up to, you just look out of the windows at the streets around you where you live, you can see that things are getting a little bit less quiet than they were. So I would be hopeful that this, one of the many ways in which this will turn out to be a special downturn, is that it could actually turn out to be relatively short-lived. As I say, it'll take longer to get back to the starting point than it took to fall from it. But I think in terms of the immediate decline, that's probably largely behind us, and we should be anticipating things getting a little bit better now. Now, that's my personal view. It's not in line, as you probably guessed, it's not in line with everybody's view. It's not in line with the picture that the media is painting at the moment. And also, I've glossed over there, I focused on the near term. I haven't addressed the issue as to the longer term picture. Will we see lasting damage and lasting changes as a result of this downturn? And many people are saying very loudly and very confidently that we will. I've been on panels where participants have said very, very loudly and clearly that this changes everything, including the way in which we organize economies and governments. So that explains the title of the overall talk. That's why I've put this point in about capitalism and whether this is not just a horrible short-term economic crisis driven by that virus. Maybe it's the last straw, as it were, for capitalism as a system, because arguably this latest downturn, it's the biggest, very special, but it follows a whole run of what we might call almost a richness of embarrassments for market-driven economies in the last few decades. So maybe this is the final straw, and some people are indeed suggesting exactly that. So in tackling that, I want to talk under two broad headings, the final two in the discussion. I want to talk about economic knowledge itself. How sure can we be about it? And then I'll offer a slightly different perspective on capitalism. So those of you of a certain vintage, and maybe this is still used, may recognize that phrase, how sure can we be? That's a phrase I remember from our August period when we had the Theory of Knowledge module at Atlantic College. At the time, I have to say, I'm afraid, I didn't take it as seriously as I could have done. I was a bit impatient with it. I think many of us were. In retrospect, it was probably the most useful single module I've ever studied. And I would say that not a day goes past that I don't use something from that module in terms of thinking about how the economy is functioning and how people are thinking that the economy is functioning and talking about it. So a very belated thank you to the teachers who put that module together, and apologies for not taking it perhaps as seriously as one should have done at the time. It's tremendously important. And the thing about economics is that a lot of people are really sure about many things in economics, and you know what? They shouldn't be, because economics in many ways is quite special. And in terms of what I do day to day, a lot of my time with our clients is spent effectively trying to filter the media and to encourage people to remember that the media generally, and the public discussion of economics generally, it is biased. It's not biased politically so much, but it's biased in the direction of sensation, drama, and narrative. We need a story to try to make sense of a chaotic world. And being human, we're more worried about what can go wrong than about what can go right. And that means that the media very efficiently fill that gap with some pretty dramatic stories and reporting. And as economists who often want to play in the media game, it's easy to get sucked into that. And the easiest way of being quoted as an economist is to say that the world is about to end. Most of the time so far, obviously it hasn't. That doesn't mean it couldn't, but that's the nature of a lot of the public debate in economics. One illustration of that, just in terms of the general response to this crisis and the way that it's evolved, very special in many ways, as I mentioned earlier, but the response has not been at all unusual. When something shocking happens, collectively, what we tend to do is we feel a bit sheepish about not spotting it in advance. We're a bit embarrassed that we didn't see it coming. So having failed to see it coming, we overcompensate after the event by becoming experts in it. We realize that it was inevitable. We explain to ourselves that it's massively important, and arguably that it's the most important thing that we've seen. It's the dominant driver of what economies are up to. And in doing that, of course, we're looking in the rearview mirror. And what we should be doing is looking forwards and wondering what obstacles are actually in the road going forwards, and whether they'll be the same one as the one we can see in the rearview mirror, or whether perhaps the road might actually be a little bit clearer than we might have thought. if those contagion rates are slowing, it's quite possible that the road ahead may be a little bit clearer than we might have thought. So that's one way in which the current episode is not that unusual. But even in normal times, there's something pretty special about much of what passes for economic knowledge. So economic knowledge, all knowledge, is elusive and needs to be questioned. But in economics and the humanities, it's particularly elusive. It's a sort of holy grail almost. What do we really know about what's going on in the economy? And it's particularly a problem because in economics, we can't reason from the specific to the general. So we can't do experiments, and we can't try to prove things by induction. If we can't go from the specific to the general, also it's extremely difficult to go from the general to the specific. Despite the best efforts of our mathematical modelers, those models don't always incorporate as much common sense as they could do. And as Kurt Gödel reminded us many years ago, or told us many years ago, axiomatic reasoning itself is not exactly free from paradox. Might come back to that in a second. But particularly in terms of modeling things, the maths that we use for that, we don't always have the most useful and sensible models that we might have. So proof by deduction is difficult as well, which means often in economics, apologies, but we have to resort to what one of my favorite profs calls a third method of proof, which is proof by repeated assertion. We say things loudly and we say them often, and we think that because we're saying them loudly and often, they must be true. And in a way, the sort of knowledge that I'm talking about here is the sort of knowledge that Donald Rumsfeld many years ago should have described as unknown knowns. What Mark Twain said, stuff is stuff that we think we know, but actually just ain't so. And in economics, there is an awful lot of that. It may be unavoidable, it may be part of the territory, but there is a lot of it. And here are some of those sorts of things. So I won't go through them in detail. You can see the sorts of things that people often assert and say. Let me touch on just a couple of them and illustrate why, in practice, some of these assertions, some of these confident assertions, may not actually be as soundly based as we would like to think. Firstly, in terms of debt, probably more than any other one macroeconomic variable, debt is seen as being the fault of whatever woes we have at a particular time. There's widely believed to be too much debt out there. I think McKinsey have done a very good job of adding it all up. They've done a good job of adding it up. I'm not sure they should have, but they have done a good job of adding it all up. And they've worked out effectively that the average person on the planet owes roughly $30,000. Now, how can the global economy possibly move forward if the average person owes $30,000? Well, think a little bit about what we're saying with that statement. If the average person on the planet owes that much, from whom have we borrowed it? If we could borrow from Mars, we would have sent the syndication desks up there a decade ago and placed the paper. We can't borrow from outside the world. So if we've each borrowed $30,000, we've each collectively lent it as well. We don't always see things quite like that because we forget that we collectively are responsible for the governments who do lots of the borrowing, and we collectively own the banks from whom we do that borrowing ourselves. Another thing that people often say about debt is that we're borrowing from future generations. That's logically not possible to do. They're not around to lend us anything, and when they service the national debt that we leave behind, they will be repaying and paying interest on that debt to their own generation. It's something which will be transferred within a generation rather than necessarily transferred across a generation. So people forget that debt is not a factor of production. It's not something which increases absolute total spending power. It's something which redistributes it within a particular cohort. And what matters with debt is who's got it, why have they got it, and what's it preventing them perhaps from doing. And if you're a very large country like the United States, if you're the Eurozone, then you can do pretty much what you want to. And the larger you get, the less likelihood there is of being in any way, shape, or form insolvent. That doesn't mean the global economy can't be illiquid, of course. It certainly can. That's where most financial crises come from. But we can do something about illiquidity. When people worry about debt and they say we may be insolvent, that sounds a little bit more alarming. We can't do much about being insolvent, but collectively, of course, that's the point, we can't be insolvent. And funnily enough, at the moment, with all the extra borrowing which is going through from governments, the capital markets are saying very loudly to all big governments that they're happy to lend as much as those governments want to borrow for the time being. Interest rates and borrowing costs generally are at the lowest levels we've seen ever. Now, that said, Venezuela can't borrow at any price. So it all depends on context. The point being that the debt debate is much more nuanced than people often imagine. What about artificial intelligence? Robots. Are robots going to do everybody's job? Of course they're not. It is the case that some occupations will be replaced by automated processes. The Luddites lost their jobs, but there will be new industries coming into being, and provided we've got decent safety nets, there's no reason why lasting job losses should be the name of the game here. Technology is the friend of prosperity and growth rather than something which destroys it. And in terms of artificial intelligence itself, I think we're miles away from seeing anything that we might approximate as genuine intelligence coming from a machine. To the extent that we think we know what intelligence is, it seems to involve being able to tolerate and to deal with paradox. And in particular, to deal with the sorts of paradoxes which are inevitable in any logical system or language. A system and language, all of which are inevitably incomplete. That was something that Kurt Gödel showed again many years ago. So, for example, if we're facing a particular problem, we know instinctively when we should be using mentally a different operating language to deal with that problem. We're not trapped in a single inconsistent language. We know that we can sidestep that somehow, but we don't know how we do that or when we do that. If we know that language A is not sufficient or complete, we implicitly know that there are other languages out there. Maybe we believe that as some sort of Platonic realism, but we do somehow believe it and know it, and we don't know how we do. So the idea that we can code that awareness into a machine anytime soon, I think, is distinctly premature. Finally, in terms of some of the things that people are talking about, I'm realizing I'm taking too much time on this. One of the other things I have to comment on in terms of things that people are saying which may not be true is that an idiosyncratic United States president necessarily means disaster. That's not the case. And again, you know, I'm choosing my words very carefully here. The president is a difficult character to admire in many ways, but I can remember another very idiosyncratic president coming into office, and by talking very rashly, he managed to convince the USSR to come to the negotiating table, and the net result was that we got rid of something called mutual assured destruction, at least for a while. Now, I'm not saying that Trump is in Reagan's league at all, or that he's even thought or planned about this, but he does have a point when he talks about trade with China. The point he's got that no other senior politician has been willing to make is that the most protected big economy on the planet by a mile is not the United States, it's China. China still has capital controls. And China, of course, knows that it's protected and knows that it should be liberalizing a little bit more quickly than it has been. But Trump is actually calling them out, as it were. I wish he'd do so more diplomatically and more tactfully, but he does have a point. And it's not inconceivable that just as Reagan bounced us into improved military détente, Mr. Trump may accidentally, by design, bounce us into improved economic détente further down the road. Finally, leading into the third and last section of the talk, people often say that this is a particularly dangerous time for the world and that the future is more uncertain than it's ever been. If you look at the data, even allowing for the horrible virus out there at the moment, the world is safer now than it has been for most of recorded history. Steven Pinker and Julian Simon's work helped make that very, very clear. And of course, the future isn't any more uncertain than it was because we're here. We're in a very uncertain position now. That must have been part of the possibilities in the past. We just didn't realize that. So those are some of the things that people think are true and maybe aren't necessarily true. Let me conclude very briefly then with offering a slightly different perspective on capitalism, because for me, the global economy is not as fragile as people think it is. Capitalism isn't immediately at risk because the economy isn't functioning. People perhaps are suggesting that there is a different mode of organization that we should be seeking as a result of this crisis on the other side. And I'm not convinced of that. I think much of the idea there is wish fulfillment, but for me, it's possible that we can have a more sustainable economy without completely overturning the current, or trying to overturn current arrangements. It's also possible that we can have a fairer economy than we have at the moment without overturning existing arrangements. So for me, it's not that capitalism necessarily is failing. The economy, I think, can recover, and I don't think it's preventing better social outcomes than we have at the moment. But I also think that people just think about capitalism, myself included, for much of my working lifetime, in the wrong way. We talk about capitalism as if it's something that we can select what's the essence of